Picture this. You've got $10,000 sitting in your regular checking account at Chase or Bank of America. You check your account every few weeks, maybe smile when you see that balance, feel pretty good about having some money saved up. Then one day, you actually look at the interest you've earned over the past year, and it's like $2.47. $2.47 on $10,000 for an entire year. Meanwhile, your friend, who you thought was just being weird and overcomplicated about money, they put that same $10,000 into a high-yield savings account, and they made $450. Same amount of money, same amount of risk, actually the exact same FDIC insurance, but a 182 times difference in returns. And here's the thing that's going to make you mad. Moving that money took them literally 12 minutes. My name is John, and I spend way too much time thinking about how Americans are collectively losing billions of dollars every single year by keeping their cash in the wrong accounts. If you're someone who's worked hard to save some money, who's got an emergency fund or cash you're holding for a house down payment, or just want to keep liquid, and you're watching that money earn basically nothing while inflation eats away at it, make sure to hit that subscribe button and give this video a thumbs up if this helps you out. Because today, we're going to talk about something that sounds incredibly boring, but is actually one of the simplest, lowest risk ways to make your money work harder for you. And I'm not talking about crypto, I'm not talking about stock picking, I'm not talking about anything complicated. I'm talking about literally just putting your cash in a different type of savings account. Look, here's what most people don't realize. The traditional savings account at your big bank is essentially a scam. Now, I don't use that word lightly, but when you look at the numbers, it's hard to call it anything else. As of late 2024, the average savings account interest rate at traditional banks is around 0.46% APY, according to the FDIC. Now, you might be thinking, okay, John, that's not great, but it's something, right? Wrong, because here's the thing. Inflation in 2024 has been running around 3.2% annually, according to the Bureau of Labor Statistics. Let me break down what this actually means with real numbers, because this is where the psychology gets interesting. If you have $20,000 in a traditional savings account earning 0.46% APY, after 1 year, you'll have earned about $92 in interest. Sounds okay, right? Except inflation at 3.2% means that same $20,000 needs to become $20,640 just to maintain the same purchasing power. You're not $92 richer, you're actually $548 poorer in terms of what that money can buy. Your bank is paying you $92 to watch your purchasing power decrease by $548. And here's where it gets really interesting. Your bank is taking that $20,000 you deposited, turning around and lending it out at 7%, 8%, sometimes 21% on credit cards. They're making thousands of dollars in profit from your money while paying you basically nothing. Now you might be thinking, but John, my money is safe at my bank. I've been with them for 15 years. I trust them. And I get it. There's a psychological comfort in keeping your money where you can walk in and talk to someone. But here's the truth. That trust is costing you real money, and the safety you think you're getting, you can get that exact same FDIC insurance, the same $250,000 per depositor protection at a high-yield savings account. So what exactly is a high-yield savings account? At its core, it's just a savings account. Same FDIC insurance, same safety, same accessibility to your money. The only difference is the bank offering it is almost always online only, which means they don't have the overhead costs of thousands of physical branches, tens of thousands of employees, fancy lobbies with free coffee and pens. And they pass those savings on to you in the form of significantly higher interest rates. As of early 2025, competitive high-yield savings accounts are offering around 4.0% to 4.5% APY. Some are even higher. Now, that might not sound like a massive difference when you just hear the percentages, but let me show you what this actually means with your money. Same $20,000 we talked about earlier. In a traditional savings account at 0.46% APY, you are $92 per year. In a high-yield savings account at 4.3% APY, you earn $860 per year. That's a difference of $768 every single year for doing absolutely nothing except moving your money one time. Let's scale this up because I want you to really feel this. Let's say you're someone who's been really good about saving. You've got a 6-month emergency fund of $30,000. You're saving for a house down payment, so you've got another $50,000 you want to keep liquid. That's $80,000 total in cash. At 0.46%, you earn $368 per year. At 4.3%, you earn $3,440 per year. That's a difference of $3,072 every single year. For 5 years while you're saving for that house, that's $15,360 you left on the table. That's a nice vacation. That's a used car. That's a significant chunk of your house down payment. Gone, because you didn't spend 12 minutes opening a different account. Here's the thing that frustrates me. I know a lot of you are still skeptical right now. You're thinking, if this is such a good deal, why doesn't everyone do it? Why haven't I heard about this more? What's the catch? And that psychological response is actually really interesting because it tells us something about how we think about money. We've been conditioned to believe that higher returns mean higher risk, and generally that's true. If someone promises you 10% guaranteed returns, yeah, that's probably a scam. If someone's pitching you on some investment opportunity that sounds too good to be true, it probably is. But high-yield savings accounts aren't an investment. They're not too good to be true. They're just a different business model. Online banks have lower costs so they can offer higher rates. That's it. That's the whole trick. The real question is, why do traditional banks get away with paying you almost nothing? Because of inertia. Because of psychology, because most people opened a checking and savings account when they were 16 or 22 and they just never changed. The bank is counting on your inertia. They're counting on the fact that you won't spend 12 minutes to move your money because it feels complicated, or you're worried about making a mistake, or you just haven't gotten around to it yet. There's actually a term for this in behavioral economics. It's called status quo bias. We have an irrational preference for keeping things the way they are, even when changing would clearly benefit us. And banks know this. They're literally banking on it. Now you might be thinking, okay, John, but what about when I need my money quickly? What if there's an emergency? Great question, and this is where people get confused about what high yield actually means. Your money is not locked up. You can transfer it to your checking account, usually within 1 business day, sometimes the same day. Most high-yield savings accounts let you make 6 withdrawals per month, which is actually the same as traditional savings accounts. Is it as instant as walking into a branch and withdrawing cash? No. But here's the thing. When was the last time you needed thousands of dollars in actual cash immediately? For most emergencies, car repairs, medical bills, whatever, you're paying with a card or a check anyway. You've got at least a day or two to transfer money. And if you really need instant access to cash, keep like $1,000 in your regular checking account and earn 4.3% on the other $79,000. But what if the online bank fails? Same FDIC insurance, up to $250,000 per depositor per institution. If the bank fails, which is incredibly rare, the FDIC steps in and you get your money back. This has been true since 1934, and no depositor has lost FDIC-insured funds since then. The bank being online versus having physical branches has zero impact on this insurance.
What about customer service? Look, I'm going to be honest with you. Have you actually had a great customer service experience at your traditional bank recently? Most of them make you wait on hold forever anyway. Online banks typically have phone support, chat support, email support, and in my experience, it's often better because they're competing specifically on service since they don't have the physical presence. What if interest rates drop? They might. High-yield savings account rates are variable, which means they can go up or down. But here's the thing. Traditional bank rates are also variable. They just never seem to go up. When the Federal Reserve raises rates, online banks tend to increase their savings rates pretty quickly to stay competitive. Traditional banks, they raise their lending rates immediately and keep their savings rates exactly where they are. Let me show you something that's going to change how you think about this. The average American household has about $8,000 in savings, according to the Federal Reserve. Let's say you're doing better than average. You've got $15,000 in savings. If you keep that same $15,000 in a traditional savings account at 0.46% APY for 10 years, assuming you don't add anything else, you'll have $15,705. If you put that same $15,000 in a high-yield savings account at 4.3% APY for 10 years, you'll have $23,282. That's a difference of $7,577 from literally just putting your existing savings in a different account one time. Now, let's say you're actually good about saving consistently. You add $500 per month to that account. We'll be conservative and assume the interest rate averages out to 4% over the next 10 years because rates will fluctuate. Traditional savings account scenario, 0.46% APY, after 10 years, you'll have $62,284. High-yield savings account scenario, 4% APY, after 10 years, you'll have $73,954. That's an $11,670 difference. That's a year of contributions you got for free, just from interest. And here's what makes this even more powerful. This is liquid cash. This isn't locked up in a retirement account you can't touch until you're 65. This is money you can access if you need it. You're not taking on any additional risk. You're not doing anything complicated. You're just letting math work in your favor instead of against you. All right, so here's where I'm going to make this super actionable, because I don't want you to close this video, think that was interesting, and then do nothing. Step 1. Research current high-yield savings account rates. Things change, so I'm not going to name specific banks because the rates could be different by the time you watch this. But as of early 2025, Marcus by Goldman Sachs, Ally Bank, American Express Personal Savings, Capital One 360, and Discover are all solid options consistently offering competitive rates. Look for accounts with at minimum 4.0% APY or higher, no monthly fees, no minimum balance requirements, FDIC insurance, this should be standard but always verify, easy transfers from and to external banks. Step 2. Open the account. This usually takes about 10 minutes. You'll need your Social Security number, driver's license or ID, and your current bank account information for linking purposes. The online application is straightforward, probably easier than the last time you opened an account in person at a bank. Step 3. Link your existing checking account. This lets you transfer money back and forth. The initial verification process usually takes a few days, where they'll make 2 small deposits, like 17 cents and 23 cents, to your checking account that you'll need to confirm. Step 4. Transfer your savings. Start with however much you're comfortable with. You don't have to move everything at once if that feels overwhelming. Move $5,000 and see how it works. Get comfortable with the platform. Then move more. Step 5. Set up automatic transfers if you're actively saving. Most high-yield savings accounts let you schedule recurring transfers from your checking account. This is the pay-yourself-first principle in action. The money gets saved before you have a chance to spend it, and now it's actually growing at a meaningful rate. Here's what this is really about, and this is where it gets really interesting from a psychological perspective. Most of us have been taught that building wealth is about making big, risky moves, starting a business, investing in the stock market, buying real estate. And sure, those things can build wealth, but they also require significant capital, expertise, time, and yes, risk. What I'm talking about here is different. This is about closing the leaks in your financial foundation. Because here's the truth. You can't invest your way out of bad financial habit. You can't invest your way out of leaving money on the table. If you're someone who's worked hard to save $20,000, $30,000, $50,000 in cash, you've already done the hardest part. You've already demonstrated discipline and delayed gratification. You've already beaten the statistic that says 40% of Americans couldn't cover a $400 emergency expense, according to the Federal Reserve. But if you're earning 0.46% on that money when you could be earning 4.3%, you're undermining your own success. It's like training for a marathon, running 26 miles, and then stopping 100 yards before the finish line. It makes no sense. And the psychological shift here is important. This isn't about being cheap. This isn't about penny pinching. This is about respecting the money you've already worked hard to save by making it work hard for you in return. Now, some of you might be thinking, but John, what about CDs? What about money market accounts? What about treasury bills? Great questions. Let's break this down. Certificates of deposits, CDs, can sometimes offer slightly higher rates than high-yield savings accounts, but your money is locked up for a specific term, 6 months, 1 year, 5 years, whatever. If you need that money before the term is up, you pay an early withdrawal penalty. For true emergency fund money, or cash you might need access to, CDs aren't ideal. But for money you know you won't need for a specific period, they can make sense as part of a CD ladder strategy. Money market accounts are similar to high-yield savings accounts. Sometimes they offer check writing or debit card access, which can be convenient. Rates are usually comparable to high-yield savings accounts. Either one works, just compare rates and features. Treasury bills, T-bills, are short-term government securities that can offer competitive rates, especially in higher interest rate environments. They're extremely safe since they're backed by the U.S. government, but they require more active management. You buy them at auction, they mature, you need to buy new ones. For a lot of people, the convenience of a high-yield savings account that automatically compounds interest daily outweighs the potential extra 0.1% or 0.2% you might get from T-bills. But if you've got significant cash and want to optimize every basis point, Treasury bills through Treasury Direct are worth exploring. The bottom line, high-yield savings accounts are the easiest, most accessible, most hands-off option for most people. They're the 80-20 solution, 80% of the benefit with 20% of the effort. Here's something most people don't think about. The opportunity cost of not doing this compounds over time. Let's say you're 30 years old. You've got $25,000 in savings. You leave it in a traditional savings account at 0.46% APY for 35 years, assuming you add $300 per month over those 35 years. You'll have $166,832. Same scenario with a high-yield savings account at 4.3% APY over 35 years. You'll have $306,572. That's a difference of $139,738. Now, I'm not suggesting you keep all your long-term savings in a savings account. You should be investing for retirement in tax-advantaged accounts with higher expected returns. But this illustrates the point. Even small differences in returns compound dramatically over time. And for the cash you do need to keep liquid, your emergency fund, your house down payment fund, your car replacement fund, those differences add up to real money. Look, I know some of you are still hesitant, and I get it. Money is emotional. Change is uncomfortable. There's a sense of security in keeping things the way they've always been, even when logically you know you should change. But here's what I want you to understand. The status quo has a cost. Doing nothing is a decision, and it's a decision that is costing you hundreds or thousands of dollars every year. You're already trusting a bank with your money. The question is, which bank do you want to trust? The one paying you 0.46% while making massive profits from your deposits, or the one paying you 4.3% because they have lower overhead costs and are trying to earn your business through competitive rates? Both have the same FDIC and